All right, looks like we're live. Welcome everybody to Live Valuation. Today in these trying times, after the Federal Reserve has finally raised its interest rate by more than a quarter percentage, up half a percentage now to between 75 basis points and 1 percentage point. Wow, we had such a nice little bump up yesterday, but then back down today. It's pretty tough being an investor in these markets. Look at that, down 14%. Not including whatever dividends we got over the last quarter. But I gotta say, our channel is in an absolute bull market. Look at us go. For the last several months, we've more than doubled the subscribers. If you're new to the channel, please subscribe to the channel to get more content like this. And if you're a returning viewer, it would be really greatly appreciated if you could like the channel if you enjoy the content that we provide here, because that will help attract new viewers to the channel. So anyway, taking a look at our watch list, definitely lots of devastation going on in some of the names that I'm also looking to buy a little bit more of. I have been a little bit excited to try and pick up a little bit more of something I've been buying more recently, Hibbett, as well as perhaps I've been thinking about getting a little bit more Fidelity. It's at a little bit better prices, excuse me, as well as Turtle Beach. I did see that they actually dropped pretty dramatically today. There is a lot of corporate kind of drama surrounding that name right now, but the valuation is just really attractive, as well as Facebook, although it keeps kind of bouncing back and forth between where I think the best buy-in point, as well as Valvoline. Those are kind of really like the five that I've been buying a little bit more here and there of. But either way, we're going to be taking a look at ticker LPX today, Louisiana-Pacific, which is a pretty interesting wood products manufacturer, specifically wood paneling and siding, as well as laminated stranded wood products. Very interesting company, connected to the overall housing market, so definitely facing a lot of the same challenges that all the names in that space have, which is to say that there's a lot of concerns about whether or not there's going to be massive slowdown in our industry, and how that will or will not affect all the various players in that space. So we'll definitely get into all of that. I think the valuation is pretty attractive regardless, but it definitely has its concerns. If you have just joined us more recently, if you haven't already also joined the Discord, you can find the link in the description below. We are trying to grow that community a little bit as well. It's a place for one, to get notifications for the streams as they first come out. You'll be able to get a little bit of a notification as I go live, as well as we're having conversations about various companies and recommendations for things that we might review on the channel, as well as covering portfolios and other investing strategies and things like that. And we're hoping to grow that community alongside this one, as well as I'm providing some free resources like spreadsheet tools and other educational materials on that page. So anyway, getting into LPX, I have already done most of the valuation as we're kind of doing nowadays, but if people come in and have some recommendations or any insightful information as to how to adjust this, I'm more than happy to take those recommendations. We're basically putting them straight into the building materials segment. I did kind of go back and forth on whether or not I wanted to put them in building materials or with the wood and lumber products kind of industry, because I do have a segmentation for both of those, but I did kind of decide on building materials as being their main category because of the more diverse aspects of how their wood products can apply. Either way, that gives us an unlevered beta of 1.7, which we will adjust for the leverage that they have. They have actually a relatively small amount of leverage, so that's actually not really a huge problem for them. Sales capital ratio for the industry, as expected, is 3.1, which is pretty relatively high, and then they also have an adjusted net margin of 9.81, which is also relatively high. So it's not a particularly high margin, but considering the sales capital ratio for the whole industry, that's a pretty strong margin. But that does have partially to do with just how much outperformance that industry has done as a whole in the most recent period. It is worth noting that in the most recent period, this company has actually had a 30% net margin versus the sales capital ratio that they have of 3.58. So they've actually beat their industrial expectation on both fronts as far as that goes. Moving down the line, most of their business is in the United States. They have 76% of the sales in the United States, with 35% of their assets, 18% of sales in Canada, 58% of the assets are in Canada. So a decent portion of the lumber assets that they have are coming from Canada, as well as the property, plant, equipment to handle such materials. But they do also have 5 to 6% of their sales coming from South America, and an approximately equal amount of their assets there as well. So there is a slight little increase of equity risk premium for them coming from the South American part of their business, but that is relatively small. It's mostly just a US based business. So after adjusting for the debt as well as the interest and tax rates, we end up with a levered beta of 1.78 because their debt to equity ratio is about 6. Like I said, they have basically no real debt. But that gets us, after adjusting for the interest rates, all the way up to a cost of equity of 12.85%. So pretty decent discount that we're applying to the company. And I also end up with a weighted average cost of capital of 9.78%, coming off of the interest rate of 3.67%. But again, they only have 6% of that in debt. So it is relatively close to their cost of equity, speaking of their debt, though, it is a really tiny amount of it, but it is at a 3.67% interest rate and a weighted average maturity of 8 years. So that's actually a pretty great debt profile. The fact that they don't have to pay back any of their debt during the cash flow projected period that we're doing, since our valuation is based off of 5 years. Effectively, the need to pay down the debt in the terms of the cash flow is really no problem whatsoever. So liquidity is really easy for this company. Not to mention the interest rates below my projected inflation rate. So anyway, getting into some of the other details, if we move back up the line, we can kind of start to take a little bit of a look at their financial history. So taking a look at that, you can see that in 2012 they had sales of about 1.7 billion or so. And in 2021, they had sales of 4.5 billion. So very large growth in their overall sales, nearly tripling over the entire period. But you can see that it's actually pretty volatile as it goes. Up 23%, down 7, then down 2, up 18, up 22, up 3, down 18, up 20, 63. So it's interesting. It's, very volatile. It's also interesting to note that they were down 18% in 2019. Not in 2020. In fact, 2020 was a very good year as far as revenues go for them. And if you see the rolling 5-year CAGR starting in 2017, it was at 10%, and then went all the way down to 6, 3, 8, 15. So even the rolling effect of their growth is relatively back and forth. If we kind of just take an average of the rolling 5-year CAGRs, we end up with 8.67%. So maybe over any given year, if you look back of the previous 5 years, what would be the likely CAGR? It's something like 8 to 9% over the given period, which over the entire time frame, I think their actual CAGR is a little bit higher than that because of the overall trip billing, but maybe not too much. This is maybe a more considerate measure to give. Now, one interesting thing about this income statement, I know I don't talk about gross margins that much, but this is one of the things that I did note was very strange about this. You can see that the gross margins has absolutely exploded in 2020 and 2021, up to 30% and 45% versus these high teens. There were some 20s in here, but mostly high teens, with occasionally even single digits. We just kind of take a look at the average over the entire period of 2019 before. It's an average of about 19% or so. Yeah, it's so the idea that it's jumped up to, we'll see the average between these 2 years is 38%. And like, I don't know, even if we just look at the average of the last 5 years, that's an average of 29% versus, again, what was the average? It was like 18% or 19%. Yeah, so it's their average gross margin over from the previous 8 years up to the most recent 5 years has jumped about 50% just in the last 2 years. Even if we assume, again, it comes back down to a point lower than the most recent year. No matter how you look at it, the gross margins have exploded, and obviously that's on the back of an overall shift in the price structures of commodities and the supply chains. But the real question is how that's going to affect their overall margins moving forward, because that has moved all the way down the line into their reported net income margins, as you can see here. We take the same sort of logic and look at the overall margins previous to 2020. The average was 4 to 5%. And if we take a look at the overall margin increase for the last 5 years, relatively speaking, it then jumps to 15%. So that means they get to keep about they've jumped to about 11%. So you notice in that case, they've basically about tripled their net margin average versus the gross margin. It had moved up about 50%. So you can see the overall leveraging and scaling of the operating costs that they have going on here. So that's the thing where it's like, it makes it very difficult to think about what we believe their margins are likely to be moving forward, because it's like, well, what do we project for their margins? I have, for example, the 3-year average here at about 15 to 16%, right? And that's the last 3 years on average, which, I mean, if you think about what the average between these 2 years, it was 24%. So it's well down below that. And I mean, what was it? I said the average for this period would be 4 to 5% versus the average for the 5-year period was about 15%. So you can say it's about 11%. Maybe they get to keep about half of that. So that's 5.5% on top of the 4.5% they already have. That gives them a margin of maybe about 10%. So you see like how hard it becomes to actually project what margins you think they might be able to get, because what margins you think they might be able to get in the future absolutely is going to devastate their value. If you think they're going to be able to keep a 20% margin, then their value is absolutely going to explode. And if you think that they're only able to keep a 10% margin, well, then their value is absolutely going to get crushed. So it becomes a little bit tricky to kind of think about this. I'm kind of trying to keep some sort of middle ground. I'm starting to think that maybe about a 15% is perhaps reasonable, which basically assumes that they can maybe keep about half of the growth in their gross margins, and it comes back down to maybe a 25% increase over the long run trend that they had, which would maybe give them maybe about 25% gross margins. And with 25% gross margins, I mean, we don't have really a large sample size to look at, but if we like kind of look at like these 3 years on average, which gets us around 25, it's kind of, like I said, it's kind of a weird way to look at this. But if we just kind of take these margins, that gets us maybe 12 to 13%. That's based off of whatever leverage they had in those previous years, however. So that's one other thing that has to be taken into account. It's a little bit difficult. Like I said, this is one of the trickier aspects of this valuation, is thinking about the margins, but I'm kind of choosing to use about a 15% baseline on the assumption that basically they're going to be able to keep maybe about half of the gross margin switch over, and then the underlying costs underneath it don't really change at all. So anyway, moving into the cash flow, we'll discuss and show a little bit about that. Let's see, the overall cash flow for the company has moved up and down over time. They don't really have any major consistent trends to point out there. Nothing huge in the acquisitions per se. A pretty decent amount of physical capex, a decent amount of depreciation, and then we don't have any development costs to particularly think about. The working capital is not huge compared to the overall capex, so it's mostly just a pretty straightforward traditional form of capex going on in the business. And they are doing actual significant capex, but it does kind of go back and forth in a trend about what they're doing at any given point. Looking at the overall payments to the shareholders, you can see over the last 5 years, they've had an average of $471 million per year to give out to shareholders. And the amount that they actually have given out to shareholders has been 524. So they've overpaid their shareholders a little bit in the last 5 years. However, if you zoom out to the 5-year period, it becomes 241 million as an average over the last 10 years. And then if you look over that time frame, it becomes 262. So they're still overpaying over a 10-year period, but it starts to narrow a little bit more closely. I'm not necessarily as worried with the payouts with this one, because it's relatively close. I know I talk a lot about companies that are overpaying their shareholders, but it's actually not by that large of a margin, as I've kind of showed here. And you can see that the way they're paying out is consistent with like the amounts that they're getting. Like they're paying out large amounts in years when they actually do have large amounts of cash flow. And then for the most part, they kind of trim back a little bit on the years where they have less. So it's not as bad as other companies where they're kind of just paying out and paying out and paying out and paying out. And obviously, like we said, their valuation looks to be pretty reasonable right now as well. Over the time frame, the most recent year is really the highest prices that they've been at. And yeah, they've been doing higher amounts of share buybacks at that point, but it also looks like the valuation is relatively good for that. So it doesn't face some of the same criticisms of share buybacks that I've had with other companies. Taking a look at the balance sheet, we can see this is one interesting factor I think about the company. While their sales, like I said, have basically tripled, their balance sheet has basically not moved hardly at all. You can see that the total assets have went from 2.3 billion in 2012 to 2.2 billion in 2021. So they've actually shrunk the assets on their balance sheet during the period. The total current assets went from 980 million to 890 million, so also shrinking, though it's a larger amount of shrinking in cash, looks like. So you could blame that as them just not holding as much cash as they used to, which is always fine. And you can also see that the net PE&E
PP&E has actually grown over the time frame. They did actually include some depreciation numbers in some of the previous years. I wish we could actually look at the overall amount of their PP&E on the previous years, but we don't really have that for these years. But if we just look at the net numbers, that actually has grown in this entire time frame. So they've grown their property and their plant and their equipment while narrowing out some of their other non-important or current assets, you guys could say, or non operationally focused assets. Non-important is kind of a bad word for it. But also take a look at the liabilities part of their balance sheet. The liabilities have also come down. So that's the thing. It's like you might be like, oh no, the balance sheet's shrinking. That's not very good. Well, they went from about 1.3 billion in liabilities in 2012 to about 956 million. So their liabilities have actually come down even more than their assets. So they've managed to grow their shareholders' equity, is what that means. That's pretty outstanding. It's like this is good capital management right here. They've shrunk their balance sheet a bit, managing to push it into equity. That equity has translated itself into market value, and they've also managed to grow their sales concordantly. Even if you were to ignore the boost that they've got in 2021 and 2022, they still would have growth over the entire time frame from 2012 to 2019, which, not nearly as much. That would be a way slower amount of growth. But again, against a balance sheet that is literally shrinking, but shrinking in a way that you actually want to see. So that's actually really good. I'm actually really happy with this balance sheet. Kind of makes up a little bit, like I said, for the fact that they're overpaying their shareholders a little bit, but they're not doing it in such a way that it's costing them anything bad of their business. They're shrinking their balance sheet to do it. That's what they're doing. It's like when a company's overpaying the shareholders, that basically means they're doing one of two things. Either A, that they're eating up their capital to do it, or B, they're issuing debt. And they're not issuing debt because they have a relatively small amount of debt. In fact, they've shrunken their overall debt over the entire time frame, but they are shrinking the balance sheet as a total, which is pretty good. I like that, especially considering it is a pretty resource-based business. That's always nice to see them managing that. So take a look at the sales capital ratio. You can see that that's grown pretty substantially over time, which has to do with exactly what I was just talking about. The overall capital base has been shrinking and being well managed in that shrinkage, while the sales are actually growing pretty dramatically during that time frame. And so overall, the sales capital ratio has grown, which means we can actually consistently believe that it'll hold over time. So that's the backdrop of the revenue the financial histories of the company as a whole. I don't have a revenue model specifically for this company. I'm kind of using a little bit more of a top-down methodology and thinking, but with that, we will actually take a look at some details in their presentation that they have for their earnings, which they have right here. They show the different parts of their business. They have the majority of their business coming from paneling, also with trim and lap siding, as well as innovative siding products. So they were talking about OSBs, which are the oriented strand boardings, as well as what's ESWs. God damn, I can't remember what the term was. The ESWs, which is god damn it, what was the freaking, God damn it, I can't remember what the acronym stands for now, but it's another essentially laminated wooding product that's used often for a lot of decks and sidings and things like that in a lot of home building projects. So again, not exactly home building, but more like a lot of home refurbishing and rebuilding and products like that. So I was looking into the overall market trends on this industry. I couldn't really find a lot of specific information on their market share, which is one of the reasons I didn't build a revenue specific model for the company. It kind of just was like settling for a little bit of a top-down approach. If we take a look, for example, at their little presentation that they have here, they're guiding it for about 15% siding solutions revenue growth in 2022, which of course sidings is only about half of their business per se, but either way, even if it's only about half their business, it's 15%, and overall it might be about 7%, or even you could say the other half of their business grows similarly 15%. So 7 to 15% sales growth is what you might be able to expect based off of that logic. And then there's other articles that kind of concur with a lot of that. However, the analysts don't seem to be projecting that. They seem to be projecting about 2 to 3%, getting to an average of 4.7 billion for 2022 revenues. And if we think about that, that's kind of in line with what I have on the revenue expectations here. However, they're also expecting about a drop of 16 to 17% in the year following that. I don't understand necessarily where that's coming from. I haven't really been able to find any like a specific event reason for that. So I think it's got to just be industry specific reasons. And I definitely have my concerns about industry specific reasons as well. But however, at the same time, as I've talked about with other things, is like, while I do think that there could be a huge slowdown in building for the next year or two, I do think the overall industry is still really, really behind schedule ever since 2008. And so the demand is still going to be pushed up regardless of interest rate rises and commodity price rises. But anyway, taking a look at what the overall industry expectations for wood-based paneling, you'll see I went to a few different websites. There's Mortar Intelligence. They're talking about expectations of about 6% between the next 5 years or so. And was this the worldwide growth one, or is this the US one? Yeah, I believe this is a worldwide based market measures. So the world paneling market's expected to grow about 6%. And then this IBIS World is another research website. They are focusing more specifically on the US market. In the US market, they're seeing an expected increase between 4.5% and 8.1% for the next most recent year, which the midpoint about that is about 6%. So I think that it's relatively similar. Another website here, Marketographics, the softboard market is expected to grow CAGR at 7% over the next 5 years. So relatively similar numbers. I'm seeing this like 5 to 7% expectation, which is kind of where I got my expected number that I decided to go for. I was kind of putting this kind of midpoint here. I do see some potential for the market to possibly shrink over the near term, but I also see lots of potential for the market to grow pretty substantially as well because of the need for this in demand. I think that if the business itself is going to have problems, it's going to be on operating expenses sides and margin sides more than the overall revenue growth side personally. So I'm putting a -4% to 12% range, which gives me a median case number of about 4%, and then I'm using about 7% as my midpoint, although maybe I'll shift that to 6%. That's actually the actual midpoint between those, which gets me an expected value of 4.91% revenues for the next 5 years. And the probability distribution is pretty heavily tilted into the median case, but I am leaning a little bit more into the optimistic end. Again, I just personally think that even though, yes, there's going to be lots of building or lots of cost pressures on the next year or so, that the overall building demand is well behind schedule. And so, yeah, they might deal with some margin issues in the next year or two, but I honestly don't expect them to necessarily have as much of the revenue issues. And unless I can figure out what it is that analysts seem to specifically think is happening in 2023, because I don't see any news about them like spinning anything off or anything like that. And with the company themselves seeming to think that they're going to grow 15% this year, and analysts not even baking that into their expectations, I'm just kind of curious how that's supposed to be. And they did already report 1 quarter's worth of numbers that is up like I believe it was high single digits on the paneling segment, which is basically puts them in line to keep growing this year the way that they were supposed to be expected to. So like I said, I'm not entirely sure what's up with the Yahoo numbers relative to what the company themselves seems to be guiding. So I'm kind of trying to like fly some sort of midpoint between those expectations, which is that, yeah, I think they're going to grow probably consistently over the next 5 years, but maybe not as much as they think they're going to grow. But maybe not as rough as what the analysts expect. But anyway, moving down into the net margins, as I was kind of saying before, I'm kind of projecting maybe about a 15% expectation in the long run, on the assumption that they get to keep maybe about half of the growth in gross margins that they've had over the last couple of years, and that about half of the rest of that comparative to the averages over the long run goes back to normal, and that's a little bit more of a transitory effect. And with that, we also assume that they're not taking on any particularly excess non-operating costs like extra debt or anything like that. And with that, that should get us somewhere in the vicinity of about 15% margin expectation over the long run. That is one aspect that I think perhaps is the weakest aspects of this valuation, because if you projected the more of an assumption that maybe they're going to drop back down to about a 10% margin, that absolutely devastates the valuation. And if you think, well, no, actually they can sustain those gross margins a little bit more further, and that they're going to be able to get something closer to a 20% margin moving forward, well, that would also have a pretty dramatic effect on the valuation in the opposite direction. I'm kind of, like I said, caught between a rock and a hard place, not really knowing exactly how to think about margins for this business. I'm choosing about 15%, which is, again, based off of assuming the average gross margin of the last 5 years and the average gross margin of the 8 years prior to COVID, that the difference between the two, they get to keep about half of it. So with that, we're of the expectation of tax rate about 22%, alongside the listed interest rate that they have of 3.67%, which is inputted in the discount rate that we kind of already talked about, but those were the assumptions that are tied to that. That all of our other assumptions, we can move on to the sales capital ratio, which is kind of the last of the major ones. Their most recent sales capital ratio is about 3.58, and I am using the most recent year as my base year, as because I had shown that because of the growth of their revenues and the well-managed capital base that they have in their balance sheet, the fact that they've actually managed to shrink their balance sheet, but with their liability shrinking faster than their assets while their revenues are exploding, that this overall large upward trend in the sales capital ratio is exactly what you would expect to see with that type of management. So actually seeing 3.5 as some sort of like reasonable basis of where it can move over time is not unreasonable. So with that, we can actually probably move it up a little bit higher than I currently have it in place, because I wasn't I hadn't thought through all the numbers when I was kind of initially putting these numbers in place. So we can maybe push this up to 4, because I do want to leave some expectations for the assumption that the revenues drop much more precipitously than the others could. Like if they drop back, for example, to even just 2022 revenues, and then compared to the current capital base, that would bring them back in line to more like a 2.5. So I do want to leave plenty of potential for them to fall back to our previous numbers, but at the same time, plenty of probability for them to stay in this 3.5 range. So expected value of 3.49, with our median case being like 2.75, that kind of pushed it a little bit up. So those are all kind of the main key assumptions, and with that, that gets us an implied return on invested capital over the next 5-year period of about 54 to 55%. So pretty insane returns on invested capital. That's against the last 3 years return on invested capital average of 52.5% or so. So yeah, pretty high in returns on invested capital, but it's actually relatively in line with what they've done for the last 5 years, though we are assuming they're actually going to do a little bit better in terms of return on capital for the next 5 years. So those are pretty much all of the major assumptions. With that, we can basically move on to adjusting for the default risk, although I did kind of do that adjustment as well a little bit when I was doing our preparation for the numbers, see if that really changed much. I don't expect that it probably did, actually. Let's see here. No, yeah, there's nothing really shifted around too much for that. So we can kind of move on and look at the summary. So that's pretty much going to do it for LPX, Louisiana-Pacific. Wood products, building materials, siding, and paneling industry, whatever you want to call that. 10-year treasury, much more solidly over 3% with the increases from the Federal Reserve. Wow, pretty interesting to see, against the mature market equity risk premium that I have of 5.24%. That being adjusted for company specific and idiosyncratic risks, I come up to a discount rate for LPX of 12.85%. And they do they do have a dividend, but I actually totally forgot to go grab that information. So my apologies for that. Ignore the 0% dividend there. I just realized I totally never went and grabbed the per share dividend numbers and put that in. It's not really relevant for actually valuing the company. It's more of just like a detail that, you know, for knowing what they provide. But yeah, oh, my bad. I just totally realized I forgot that one. But either way, they had sales 5 years ago of $2.2 billion or so. And the most recent year, it was 4.5 billion. That gave them sales growth of the last 5 years at a compounded rate of about 15% per year. They had sales to capital ratio in the most recent year of 3.58, and against the industry expectation of about 3.1. Returns on invested capital for the last 3 years on average has been about 52.5%, and the debt to equity ratio is currently about 6% or so. Default risk in the most recent year is a pretty default level of about 1% per year, nothing too major. And profit margins for the last 3 years on average has been about 16% against the industrial expectation of about 10% or so. And they have profit in the most recent year of $1.3 billion, and they're currently selling for $77.51. For our future assumptions, the probability distribution that we're going to use is pretty heavily weighted into our median case third model, with a little bit of heavier tilts towards our more optimistic fourth model versus the second model. With that, we do have revenue expectations of anywhere from the worst case scenario of $3.7 billion to possibly a best case scenario of $8 billion. On an expected basis, we see $5.7 billion. That gets us a revenue growth rate of negative 4% per year in the worst case scenario to possibly positive 12% in the best case scenario. And that gets us an expected growth rate of about 4 to 5%, just about 5% per year for the next 5 years. Sales to capital ratio, we have an expected value of about 3.5. Returns on invested capital of about 55%, and the debt to equity ratio about 7.5%. We do see pretty much no default risk for the company overall because they're not really taking on too much debt to operate anything here. And the profit margins, we have a distribution of anywhere from about 10% to 20%, though as I've kind of noted multiple times in this valuation, that I do think that's the weakest part of my assumptions here. Definitely the part where it's definitely a little bit of a total spitball of assumptions. You know, your guess is as good as mine when it comes to margins. But either way, my expected value comes out to about 15 to 16%, and we end up with profit distribution of anywhere from $371 million in the worst case scenario to possibly $1.6 billion in the best case scenario, which gets us 910 or so on an expected basis. We have an expected present value of $86.80 per share, which is about 12% higher than the current share price. 5-year forward value targets unadjusted for the dividends that they do pay out. Like I said, my apologies, I totally forgot to grab that, but they do pay out a pretty small dividend. I think it's like 1.5–2% or something like that. It's a pretty small dividend. Anyway, value targets of anywhere from $76.62 to possibly $278.36. On expected basis, we see $158.87, which gets us a return expectation of 15.5% or so per year for the next 5 years. Hey, Nugget, yeah, definitely looks pretty appealing. You know, like I've said, whenever covering a lot of the home builders or anything related to the real estate market, it's like there's a lot of very appealing companies in this space, because, you know, everybody's concerned about the industry. Nobody wants to be holding those companies on the falling knife, so to speak, which that's just the truth of it. You know, this looks like a great company to own, but you very well might have to deal with some rough volatility in the short term in order to hold it. But it looks like anybody who's willing to hold it from now to 5 years from now could definitely have a great time. But as I have said, this valuation is definitely very sensitive to the margin assumptions, and it's pretty sensitive to the revenue assumptions as well. I'm probably not going to necessarily jump at it too immediately, just because I do have a decent amount of exposure to a variety of stuff in the real estate space. But I'm definitely watching. I'm tempted. It looks like a very high quality business. Hey, Avador, what's up? So anyway, we will go ahead and take a look at a couple other things. I'll kind of close out some of these the market-based things on the research stuff. I will say, talking about the relative valuation tool that I've kind of was talking about on the last stream, and I'm trying to kind of promote a little bit to the people who have joined the stream and may not have been there at the beginning or weren't there necessarily last time. I see I got one like already. If other people could like the stream, it'd be very appreciated. I really appreciate that. If anybody wants access to this relative value tool, it is a free access in the Discord, which you can find the link to in the description, as well as it is the pinned comment in the chat. This is kind of the tool I'm using to try and screen for stocks a little bit more in the future. You can put all the numbers you want into this page here, which I can kind of show you a little bit how it works. Let me try to show how this works. I don't know why there we go. So we'll go ahead and select a company. Why not? Let's do Walmart. Want to understand how this tool works? You can come over here to Yahoo Finance, and all you need to do is get all the information from Yahoo Finance using the tool. Yeah, don't. You can enjoy the wallpapers. I have a pretty interesting folder full of cool art that I like as my my backdrops. So whenever you use the tool, you can kind of just set it up like this. So splitting your screen is so. Putting the ticker into the left-hand columns here, only put information into these kind of like beige yellow columns. For the main set of information, you come over to the financials. And the income statement and the balance sheet is basically where most of the information is. TTM sales basically just means the total revenues. You put that in. I personally like to, it's all the numbers are in thousands, and so I suggest ignoring the last set of 3 zeros because it's easier to look at things in millions in my personal opinion. So that's kind of the way I like to put things in.
put the sales in. You can click on the operating expenses to see if they have R&D expenses. If they would have R&D expenses, it would be below the selling, general, and administrative costs, which they do not have any. So if that's the case, then you just leave that space blank. On the net income line, that comes down to right here, the net income to common shareholders, 13,673. So put that into this line here. Then come over to the balance sheet. And to find the cash balance, you click in the total assets and click into the current assets, and then cash equivalents and short-term investments. Click on that. I always suggest clicking on this and making sure it doesn't include the short-term securities. A lot of times a lot of people like to include those, but I think that's a little bit of a risky thing to do because of the way that bond prices can lose a decent amount of value in a short period of time. Just take a look at the bond market over the last 3 months if you need any evidence of that. But either way, they don't have any of that listed here. So 14.76 billion, be 14,760 million right there. And then total debt, you can come down here to this line, 57,323. Put that in here. Book equity, you can find that right here, 91,891 there. And then for the last 3 lines is the analyst projected numbers we need. The next 2 years worth of sales projections, as well as the EPS projection, which you can find on the analysis tab right here. The revenue estimates come down to this page right here. These 2 numbers are the projections for 2023 and 2024, which is the next 2 fiscal years for Walmart. I guess they've already reported their 2022 numbers. Some companies, you know, have their fiscal year set up a little bit of a different way. So put those numbers into the first 2 sales numbers there. And then for the EPS number, you scroll down to the growth estimate over here where it says next 5 years per annum. This 8.35% is the number I'm looking for. And then I just put that number right in there. So now I can kind of come over here and see that this line gives me the overall projection of potential value for Walmart. It gives me the share price right here, the market cap, and the distance from the 52-week high. So it's only about 5% down from this 52-week high. We're putting its sales, its income, as well as the projections on that. I see that they have a net margin of 2% and a PE ratio of 30 against an adjusted net margin that's about the same because they don't have any R&D costs. So these 2 columns really mostly just apply if you actually put R&D costs in there, because that means I'm probably going to make their margins a little bit better, and that also makes their PE a little bit better. But either way, still price of sales of 0.73. Which if you adjust for the debt to equity ratio, which is 13 to 14%, then they actually have an EV to sales of 0.81. Sales capital ratio of over 4, which is pretty typical for a retailer like Walmart. And then returns on invested capital 11 to 12%, nothing too amazing. However, the fair value estimate I get for them, based off of the earnings that they have and the multiple that we're assuming for them, which were, by the way, the multiple, I'll get to that in a second. Fair value assumption I get is $211. So even based off just this basic screen, it actually makes Walmart of all companies look like a pretty decent value. Nothing too amazing, but a decent value nonetheless. Now, to explain how the fair value estimate works, I'll say how this goes. We're using the growth estimates to estimate what their earnings are 5 years out from now, but then we're multiplying it by a consistent multiple. And whatever multiple is going to be used depends on whether or not this box says yes or no. As you can see, we can switch this box right here, and the estimates all switch around pretty dramatically. And it also switches this number. Now, this is the key important thing that you need to understand, is that what that number means. It goes from 12% to 7%, and this says rate of return at fair value. What that implies is that if you bought the stock at this return and it earned the earnings that we've projected for it, then it would earn that rate of return ongoing at that price. So it basically means that if you are, we can change it around and to make it say that Walmart is a fair value at $607, but that assumes that they're going to grow 8% per year for the next 5 years, and then you only want 7% per year forever. And if you want higher than that, if you want 12% per year, then Walmart is worth $200 per share. So you have to understand what the fair value estimate actually implies, because it changes basically the PE ratio that we're applying to it, but either to be based off of the average of the group, which you can find down here. The average PE for this group is 23, or it can be the long-term average of the S&P 500, which is about 16.
So basically, the reason why one of the values showed Walmart as being worth a lot more was that we were saying that a PE of 23 is good enough for Walmart, even though the 10-year treasury is currently a 3% treasury, which is kind of an insane PE to apply to a low growth company with a 3% treasury rate. So that's kind of the reason why it works out that way. This tool should not be used as any sort of final investment decision. This should only be used as something to point you in the direction of where to research more. I just want to make that clear to everybody. That these things vary pretty wildly from like the type of valuation that I do in the full spreadsheet template that I have for each individual company. I come up with entirely different numbers by the time I do all of those estimates. So just want to point that out. This is just something to kind of make it so you can compare companies side by side, as well as take advantage of the graphs that I have down here that put these numbers next by side. Yeah, thank you very much, Nukit. I'll catch you next time. But you know, I'm actually probably going to be calling the stream here too, guys. I just kind of wanted to show this off one more time to kind of incentivize people to join the Discord to take advantage of it. We're gonna be taking a look probably at Western Digital next on Monday. That's the stock I'm next looking to go into after one of our main viewers on the channel had pointed out to me that this activist investor had taken their position in it, and so it's definitely had jumped its interest into me as well. Not to mention, if you look at it on the relative valuation tool that I have down here, I do actually have Western Digital in here, and it does itself seem like a pretty decent value, worth perhaps about $95, $96 per share, which the activist investor himself seems to believe that they're worth perhaps about $100. So that is perhaps a decent opportunity to find right there. Hey, Dr. Crisis, how's it going? I did just go over the tool pretty in depth for the last 5-10 minutes, and I did on the last stream as well. I'm probably going to be trying to do a standalone video on it at some point in the future. But if you wanted to try to get your hands on it in the Discord link, and then just wanted to maybe like message me your questions on the Discord, that's always an option too. People can always feel free to contact me with their questions via personal message in the Discord. Anyway, that's going to be it for today, guys. If you enjoyed the stream, please do like. I do see the 2 that I already got on there. Thank you very much for that. And I